Hello everyone, this is Rajiv Nair, Senior Manager from ICICI Securities Mutual Fund team. Today we are going to learn about Vito Capital Balanced Advantage Fund, which is their NFO. And to understand that, we have Mr. Pratik Fund, who is the Chief Business Officer from Vito Capital. Welcome, Pratik. And first thing first, tell me something about Vito Capital so that our audience will understand from where this particular thing is coming up.
First, thanks a lot, Rajiv, for having me here. A warm welcome to all the audience who are here. Vito Capital is relatively a new asset management company in this space. We launched our first mutual fund just about 7 months back in July last year, which was our FlexiCap fund. But we have a very strong track record even before launching a mutual fund. So our founder, Prashant Khemka, actually set up Vito in June 2017. Prashant came from a background where he used to be the chief investment officer at Goldman Sachs, running both India and emerging markets, and has more than 2 decades of experience of running an investment setup. So in a way, Vito is one of those firms who has a very strong DNA of running investment management, and this is the only thing which we do, right? So while the mutual fund journey is relatively younger, our journey of managing investments for clients, global clients who have wanted to invest into India, has been a lot more checkered, and we've been doing that almost for now 6 years, and manage almost close to 50,000 crores of money right now in equity assets.
So we have a pedigree of professionals as a founders, right?
Absolutely, Rajiv. So as I said, Vito does not have a bank, broking company, or a distribution company like ICICI Securities. The only thing which we do is really manage money, investment money of investors who are looking to invest into India.
Okay. So coming up to this particular fund, which is an NFO, Pratik, Balanced Advantage Fund or Dynamic Asset Allocation, these things are interchangeably used many a times. Could you share some lights on that?
Sure. So, Balanced Advantage Fund is a category which has actually got into prominence very recently, right? Over the last, I would say, 5-7 years, much shorter time frame than where equity mutual funds have been around for almost now 25 years plus, right? And within a short period of time, this has actually become a 2 lakh crore category. What typically happens is that we've seen different market cycles, right? And I may to just show this, I may actually show a couple of charts around here. So if you see equity, the history of equity markets, right? We know equity markets over a long period have given quite significant returns. Yeah, from the time the Sensex was there, we've seen 16% return in that period. But that period has also seen a lot of volatility. From having 9/11 to actually the period of dot-com bust to seeing taper tantrums, global financial crisis, and very recently the pandemic, right? The markets have been fairly volatile and the returns from equity markets have been very volatile. Now, having said that, when you look at this type of track record, you still see that the equity markets have given 16% return. Many periods, many times what happens, Rajiv, is that when investor actually looks at his own portfolio, right, he realizes that his returns from investments have been significantly lower than the returns which have come in from a fact sheet of a mutual fund, right? So you're saying equity markets have given 16% return, but the investor sees I've made half of those returns. It's because during times of volatility, investors, start panicking. So in fact, there is an old saying which says, be fearful when others are greedy and greedy when others are fearful. It's a great thing to say in theory, but practically very few people tend to follow that. Now, if there was a method in which you could invest more into equity when markets are down and invest less into equity when markets are up, right? Or markets are expensive, that is really where, which is the, complete panacea. But we've heard pundits say, right, it is impossible to time markets. We don't know when markets are expensive and the emotion takes better of us. I can tell you, Rajiv, after having dealt with more than 2 decades of investor sentiments, we knew so many seasoned investors in March 2020 during pandemic who pressed the sell button and kept, kept their holdings in cash till markets had actually gone up 40-50% after that. And then they went into the market and have seen complete flat returns from the market at that point of time. Now, to do away with this whole emotions and behavior of investing, what multiple asset management companies have done, they've created their own models of seeing how to get in and out of equities at different points of time. Now, these models have different bases, and I'm not talking about everybody else's model out here, but there are different ways in which you value the markets. Mutual fund as an umbrella is a very efficient way to do this. And why is it efficient, Rajiv? Is that every time a mutual fund sells out of equities or buys into equity, as an investor, you have to pay capital gain tax, right? You could have exit loads, which could be there. But when a mutual fund does that within a mutual fund structure, there are no exit loads, there are no taxes, there are no other type of transaction fees which are there. So within a mutual fund, if you balance between equity and debt, depending on how market valuation levels are, you are in a way trying to get this whole experience of the market without necessarily panicking at different points of time. And I think that's really where this whole dynamic asset allocation or balanced advantage fund has seen its roots. So typically a balanced advantage fund should be investing more into equity when you see markets are at lower levels, or markets are looking relatively cheap, and should be actually investing less into equity when you see markets have become expensive. So that's really the basis of how the balanced advantage fund category has found. And what has happened because of that, Rajiv, is that while markets, as I showed in the earlier slide, may have been volatile and have given those type of returns, but with this moving in and out, you've tried to play around the volatility and ensure that volatility for your own returns is equal to what actually the investment should be able to give you.
Prateek, while an investor will come with an returns, definitely volatility is going to be the inherent nature of any market. And we talk a lot about asset allocation. Could you share some pointers on that as well?
Yeah, so, as I said, typically, Rajiv, what we always say is that rather than, depending on what your risk profile is, when I say risk profile, how susceptible are you to getting swayed by what happens in the market? So suppose there is, we've seen that last year, right? There is a Russia-Ukraine war which happened, which nobody anticipated. And because of that, crude prices went up. Because of that, inflation has gone up. And because of that, a lot of markets around the world have had a fairly negative experience. Now, that brings a lot of volatility to what returns come from equity. Now, if you have a portfolio which has exposure across debt, equity, and at times gold, right? You find that you can, if returns from equity tends to be at a lower level, right? The returns from debt tends to compensate out there. So depending on your own risk profile, right? Depending on what your objectives are in terms of what returns are you trying to achieve over a period of time. And then finally, what is the time period you have to achieve those goals? You will tend to allocate between equity, debt, and gold, right? And that's really a function of how an advisor like you, Rajiv, would guide investors, or what percentage of their portfolio should be in equity, what should be in debt, and what should be in an alternate asset class. Historically, we've seen returns from each one of these asset classes have been something, and you can really backtest that type of data to really determine if you're an aggressive investor, you could be anywhere between 60 to 80% in equity. A conservative investor or a balanced investor would tend to be about 40 to 60%, while a conservative investor could be anywhere between 10 to 30% in equity, depending on how he looks at the volatility at any point of time.
As Prateek, you have mentioned that balanced advantage as a category is relatively having 2 lakh crores in the investor pool. And that's the kind of an AUM which this category is currently ongoing. Along with that, we also know that justifies that a lot of audience is aware about balanced advantage fund as a category. So how White Oak Capital balanced advantage fund will make a difference in their life if they come today for investments?
Okay, so I think Rajiv, it's a very, very important question, because see, every balanced advantage fund has a certain objective which has been laid out when they've actually created their own internal model, right? So we have created an internal backtesting model of allocating to equity at different points of time. This model really is based on a couple of very simple basis, which is we look at what is the price to book with an overlay of return on equity. Now, I mean, there are many formulas I can talk about, but basically we are looking at what is the valuation of equity markets. And the second is a ratio called yield ratio, which actually talks about the attractiveness of GSEC yield to the equity yield. So when I do an overlay of these two, I actually come at a internal valuation model which determines what percentage of equity should be there at any point of time. And the range could be anywhere between 30 to 80%. Now, I have created clear defined objectives of what is the success of my model out here, right? The first thing which we're trying to do, Rajiv, is how could we, outperform fixed deposit returns over a 3-year rolling period. That means we are targeting at any point of time on a 3-year rolling return basis, we should be able to, with certain degree of confidence, generate more than 8% returns, right? So, that's my first objective, which is there. So if we can do that with, least amount of volatility, that's my, one defined objective, which is there. The second is, of course, could we outperform the CRISIL hybrid index, which is there, which is that 50-50 index. But in trying to outperform that, my first objective cannot be compromised, which is about trying to generate FD plus returns with very little volatility, right? And the final objective is, of course, to see how we can, over a certain business cycle, be among the top BAF funds which are there, but without, again, compromising my principle 1 and 2. So if that is the objective, if you see, again, this is an internal model, this is backtesting data, Rajiv, which is there at different points of time, right? And we have tested this model from 2010 onwards. You would see that, this particular model versus the index, right? Our benchmark is, of course, the hybrid 50-50 index. Index, the Sensex is just a reference point out here. But if you see in a year like 2011, where the Sensex had a pretty tough year, where it delivered minus 24% return almost, this model actually managed to limit downside very significantly. A lot of times, Rajiv, generating returns is actually about protecting your downside more than participating in the upside, right? And if that happens, when you have a year like 2012, where the Sensex delivers 28% return, we still manage to deliver a 20% type of a return and are creating wealth for investors. I think an interesting year is the year 2020, right? Where we know the pandemic hit. And that was the year the Sensex actually delivered about 17% return, but this model delivered 27% return. Now, over a period of 12 years, as you can see, while the Sensex has actually delivered about 12% return, the backtested model, which has delivered 13% return. But let me put a caveat out here, Rajiv. My objective is not to beat the Sensex, right? Well, as I said, my objective is very clear. So this is incidental that we have actually outperformed even the Sensex. But my objective is that when you look at 3-year return, right, which has been generated at any point of time, right? The rolling returns of 3 years, if you had to see, and this is a very important slide, to really know, if you had to look at any 3-year period, right? Our model, 99.6% has actually done more than 6% return, which, is basically a post-tax return of FD of 8%, right? So at 99.6%, while if you had to see the volatility of the Sensex during the same period, on the right-hand side, you can see the Sensex actually has delivered 88% period, more than 6% return, right? And again, out here, almost 92% of the time, this particular model would have actually delivered a double-digit return versus Sensex, which has done 66%. So while we all agree that over a long period of time, as I just mentioned, Sensex has the capability of delivering 15% returns, which it has done over the last 40 years. But there is a lot of volatility which comes in this. This particular reallocation from debt to equity and equity to debt, which actually the model delivers, ensures that you are able to generate, close to double-digit returns with very, very little volatility over 3 years and 5 years rolling periods. And that's really what we are trying to achieve here, Rajiv.
Prateek, this brings me to my last pointed questions, because there is a beautiful data to understand the theory of asset allocation, how whether equity or a debt. So any investor will ideally look forward from a return perspective. So from that point, how much an investor, if you can just give me a broad range, I know with the
Sure.
SEBI regulation, we are not permitted to give any assurance of returns, but yes, an indication can be there with a time horizon an investor should stay committed.
Sure. So Rajiv, I think I'll just address one point before that, is that what is the typical profile of the investor who also looks at balanced advantage fund, and then
that's true.
Talk about the returns in conjunction to that. So in my mind, Rajiv, there are 3 categories of investors who should definitely look at BAF category, right? The first is a new to equity investor, right? As a lot of people have heard about equity, have heard about the compounding story, but really, it's like, when you go into a swimming pool during the winter season, right? You just dabble your feet around there, you're wanting to test how cold is it, right? Before you actually commit to the water. Now, this is really that type of a product, right? You're dabbling your feet around there. You're actually seeing how cold is it. Am I able to, harness the volatility to generate longer term equity return? This actually helps you, give you that level of entry into equity without necessarily taking that type of volatility, right? The second category of investors are investors who are seasoned investors, but who are very, very wary of the volatility of equity asset class, right? And these are investors, who have seen these type of crises, whether pandemic or global financial crisis or taper tantrums or many of these things, completely eat away their returns which they generated. तो कहते हैं ना वो ठीक से रात को नींद नहीं आती है मेरे को मार्केट को देखकर. तो मतलब when you have that type of a feeling which is there, that's the other category I think which is really targeted very well. The third, right, in my mind, are really the category of investors today. If you see, retirement is a very big category. Earlier, people used to make pensions, right? Now, today, the pension is not available for many people, right? And if pension is not there, then what do you really do? That's the time you actually look at a product out here, right? Where you can actually, I just want to show, sorry, I'm just trying to show a particular, slide which actually talks about an SWP, right? Which is, in my mind, a very powerful product today, a powerful way in which you can actually generate monthly income without necessarily participating in the volatility of the equity asset class. So hypothetically, right, you were an investor who had received a saving of about 1 crore, and this was, and you need a regular flow of income which needs to get generated from there. We say, you need a 75,000 rupees per month or 9 lakh rupees every year from there. Now, if someone like that would have invested 1 crore on Jan 2010, which is where I've started this particular model, you would have seen over this period of time, in the last 12 years, he would have withdrawn about 1.14 crores from his systematic withdrawal plans, which is about, and at today, at the end of this year, he still would have about 2 crores of value of units which are out there, at a net post-tax IRR of about 12%. Because your capital gains out here are getting, taxed at an equity taxation level, you are able to generate these type of outflows with tax rates which are lesser than 5% in being able to generate this type of income. So for all these 3 investors, Rajiv, it becomes very important to actually look at this. Now, while historically, as I've shown you that, the model has delivered, about 12% or type of returns, but as our objective, Rajiv, out here, as I said, when you look at historical performance of equity as an asset class in India, and with the story what equity has to offer, we believe we are targeting to generate, fixed deposit plus returns, which is, target about 8% type of a return So this lies somewhere between debt and equity, right? If debt is giving you about 6% return, equity is giving you 15% return. The band of trying to be between 8 to 12 is what a balanced advantage fund should do, with very, very little standard deviation of volatility, so that, in a 3-year or a 5-year rolling return, you are, in that particular range. So that's the range at which, these type of returns should come from a balanced advantage fund.
Okay. So Prateek, we had a brief discussion in and around the fund. We understood what is Vito Capital, the dynamic asset allocation strategy, more particularly how you guys will be doing this particular stock to equity kind of a portfolio mix. So I'm sure the investors would have got the message how this particular fund would benefit them if they today look forward to go for this NFO, which is ongoing for subscription from 28th Jan till 3rd of Feb. I'm sure the investor will make informed decisions and will get the benefit of this particular fund. And with this, we look forward to close this call. Thank you very much, Prateek. Thanks for joining.
Thank you, Rajiv. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.